Ladies and gentlemen, listen carefully because what I'm about to tell you could affect every ounce of gold and silver you own. The Federal Reserve just sent shockwaves through the financial system, and most investors don't even realize it yet. If you think this is just another headline, think again. This is the kind of moment that separates the people who preserve their wealth from those who lose it. And today I'm going to show you exactly why gold and silver are not just investments. They are your financial lifeboats in a storm that's already brewing. You need to understand something very clearly. When the Federal Reserve makes a move, it is never just a technical adjustment. Every decision, every hint, every subtle statement is a signal not just to Wall Street, but to the entire global financial system. And right now, the signals coming from the Fed are flashing red. We're talking about a shift that could reshape markets, influence currencies, and directly impact the value of gold and silver. Most people don't realize this. They see interest rate changes or policy announcements and think it's just numbers on a page. But that's a dangerous way to look at it. The Fed is the central nervous system of the U.S. financial machine. When it twitches, the rest of the body reacts, sometimes violently. Let's start with the basics. Interest rates are the Fed's primary tool, but they are not the only one. When the Fed raises rates, lowers rates, or adjusts its balance sheet, it is signaling expectations for inflation, economic growth, and financial stability. But what's critical, and what the mainstream often misses, is that these actions have a cascading effect. Rising rates can strengthen the dollar, yes, but they can also increase borrowing costs for corporations, slow economic activity, and put pressure on debt-laden governments. Conversely, lower rates can stimulate the economy in the short term, but risk and fish and currency devaluation and the erosion of wealth for savers. So every Fed decision is a delicate balancing act, but a balance that rarely satisfies everyone and sometimes fails spectacularly. Now consider this, the Fed doesn't operate in a vacuum. Its moves are closely watched by central banks around the world. When the Fed acts, global capital flows adjust. Emerging markets feel the impact immediately, often in the form of currency pressure, rising interest costs, and capital flight. Institutional investors and hedge funds analyze Fed statements with laser precision, anticipating how every nuance could affect our portfolios. The ordinary investor sees the headlines, but the smart money reacts in real time, often creating a feedback loop that magnifies the Fed's initial action. And here is where gold and silver come into play. They are not just commodities. They are the ultimate barometer of confidence in fiat currency. When signals from the Fed suggest instability or uncertainty, gold and silver respond sometimes sharply. What's happening right now is subtle but significant. There are changes in tone, changes in forward guidance, and even slight alterations in the language used in official statements. These may seem minor, but in financial markets, words carry weight. A subtle acknowledgement of inflation risk, a nod toward potential liquidity tightening, or even a hint at balance sheet reductions can trigger market reactions that ripple across currencies, equities, and commodities. This is not conjecture. History has repeatedly shown that markets react not just to policy itself, but to the signals it conveys. And when the Fed signals a major shift, the response in gold and silver is often immediate as investors seek safe havens against uncertainty. Debt is another critical factor. The United States carries trillions in outstanding obligations. The Fed's policies directly influence the cost of servicing that debt. A small miscalculation in interest rate policy could dramatically increase borrowing costs, forcing adjustments in fiscal policy, market liquidity, and international confidence in the dollar. Investors who understand this see the connection clearly. When the cost of debt rises or when liquidity conditions tighten, the demand for tangible assets like gold and silver often spikes. This is not speculation. It is risk management. Those who ignore it do so at their own peril. Let's talk about timing. Market participants who anticipate shifts often get ahead of the curve. They watch economic data, inflation indicators, and even geopolitical developments that could influence Fed decisions. The subtle signals we've seen, slight deviations in inflation forecast, changes in employment guidance, hints about future asset purchases are not random. They are the Fed's way of telegraphing future strategy, allowing the market to adjust gradually rather than a sudden shock. But even these small signals can have an outsized effect on asset allocation. Gold and silver in particular react because they are universal measures of value outside the reach of any single currency or interest rate regime. The critical takeaway here is that the Fed's moves are not isolated events. They are part of a complex system that links domestic monetary policy to global markets. Every tweak, every word, every adjustment is a signal that, if interpreted correctly, can guide investment strategy. Those who see these signals clearly understand that gold and silver are more than investments. They are insurance against systemic risk. a hedge against the erosion of currency value, and a store of wealth that transcends borders. Ignoring these signals is not merely risky. It is strategically announced. In the end, the message is simple but urgent. The Fed is signaling major shifts, and the implications are enormous. The smart investor recognizes these signals, acts decisively, and positions themselves to protect and grow wealth. The rest will only realize too late that monetary policy is not just about interest rates. It is about the very foundation of financial security. Gold and silver are the clearest indicators of how seriously we should take these shifts, pay attention, understand the signals, and act before the consequences of an action become impossible to reverse. In a world where the rules of finance seem increasingly unstable, gold and silver remain the one constant, the anchor in a sea of uncertainty. They are not just commodities. They are insurance policies written in metal immune to the whims of government, central banks, or speculative bubbles. Investors often underestimate the psychological and structural importance of precious metals. When markets are calm, gold and silver may appear quite uneventful. But when the storm hits, they are often the first to signal danger and the first to provide refuge. This is why they are considered safe. Heaven's not by chance, but by centuries of proof. The first thing to understand is that currencies are essentially promises: a snort, a dollar, a euro, a yen. These are commitments by governments to maintain value and stability. But history teaches us that these promises can and do fail. Hyperinflation, currency devaluation, debt crisis. All of these are stark reminders that paper money is not a permanent store of wealth. Gold and silver, on the other hand, have intrinsic value that cannot be printed at will. They are tangible, universally recognized, and outside the reach of any single government's balance sheet. When confidence in fiat currency falters, investors naturally turn to precious metal to preserve purchasing power. Consider the modern financial system. It is built on debt, leverage, and expectations. Banks borrow from central banks, corporations borrow from financial markets, and consumers borrow to maintain lifestyles. This entire system relies on trust, that obligations will be honored, and that money retains its value. But the Fed's recent moves, as well as global monetary shifts, remind us that trust can be fragile when uncertainty enters the system. Whether through inflationary pressure, geopolitical risk, or policy missteps, gold and silver act as stabilizers. They are the assets that survive systemic shocks, the ones that cannot be manipulated through conventional monetary policy, and the ones that preserve real wealth over decades, not just months. Moreover, gold and silver are liquid assets with global appeal. Unlike real estate, collectibles are complex financial instruments. They can be bought, sold, or transferred anywhere in the world. This universality matters in times of crisis. When snorts, currencies weaken, or markets collapse, gold and silver do not lose their intrinsic value. Their worth is recognized across borders and cultures. Investors who fail to include these metals in their portfolios often find themselves exposed, relying solely on instruments that are vulnerable to policy changes or currency risk. Safe havens do not promise exponential growth. They promise survival, protection, and continuity. In gold and silver have done so consistently through centuries of economic upheaval. One of the most compelling reasons investors turn to gold and silver is their historical track record during periods of hyperinflation, currency devaluation, or banking crisis. These metals not only preserve value, they often increase in relative terms. When paper money is losing purchasing power daily, an ounce of gold or silver holds firm. This is not speculation. It is documented fact. In countries where economic collapse is struck, gold and silver often become the only reliable currency for transactions, a lifeline when the banking system fails. The message is clear. In times of uncertainty, tangible assets outperform promises. Another critical aspect is psychological security. Financial markets are unpredictable, and volatility can shake even the most seasoned investors. Gold and silver provide confidence that no matter what happens in the stock market, the bond market, or the foreign exchange markets, part of one's wealth is secure. This psychological edge is not trivial. Markets often move on perception and expectation, and when investors know they have a portion of wealth safeguarded in tangible, universally accepted assets, they are less likely to panic, less likely to sell at the worst possible moment, and more likely to make rational strategic decisions. Furthermore, gold and silver act as a hedge against policy missteps. Central banks around the world, including the Fed, often face conflicting priorities: stimulating growth, controlling inflation, and maintaining currency stability. Mistakes are inevitable. When policy miscalculations occur, investors exposed solely to paper assets or interest instruments suffer losses. Gold and silver, immune to these errors, rise in importance precisely when conventional assets falter. They are not just a hedge against inflation. They are a hedge against human error, policy risk, and the unintended consequences of complex economic systems. It is also important to recognize that these metals have asymmetrical advantages. While other assets may fluctuate based on investor sentiment, corporate earnings, or geopolitical developments, gold and silver are inherently scarce. They cannot be created at will. Their supply is finite and constrained by nature. This scarcity ensures that their value cannot be easily diluted. Unlike currencies or financial instruments subject to printing or manipulation when confidence in paper assets declines, the limited supply of gold and silver makes them even more desirable, driving prices higher and reinforcing their role as a safe haven. Ultimately, owning gold and silver is about preparedness. It is about understanding that wealth preservation is as important, if not more important, than wealth accumulation. It is about recognizing that when uncertainty strikes, markets can move faster than analysis, and protection must already be in place. Safe havens are not speculative gambles. They are defensive strategies. Gold and silver provide certainty in an uncertain world. They're proof against policy risk, economic turmoil, and currency instability. And for investors seeking real protection, they remain the most reliable choice, the ultimate hedge, and the most enduring store of value the world has ever known. Paper currency is often treated as the ultimate measure of value, a convenient tool for transactions, and a supposedly stable store of wealth. But if you look beneath the surface, the reality is far more precarious. Currency is essentially a promise, a claim on the future productivity and stability of a government and its institutions. Unlike tangible assets such as gold, silver, or real property, a piece of paper with a printed number only has value because people believe it does. And belief, as history demonstrates, can be fragile, fleeting, and easily shaken. The first risk lies in the very nature of money creation. Governments can and regularly do increase the supply of currency. They print more money, inject liquidity, and expand credit in ways that are invisible to ordinary citizens until the effects become undeniable. This is inflation, the silent thief that erides purchasing power. It doesn't annoy with headlines. It works quietly, reducing the real value of your savings, your investments, and your future income. Those holding only paper currency are exposed, often without realizing it, to a loss in value that accumulates daily like a slow leak in a boat. Debt compounds the risk. The United States, along with many other nations, carries astronomical levels of debt, both public and private. Servicing this debt requires continuous flows of currency, often through interest payments that consume real economic output. When obligations become too large relative to the productive capacity of the economy, governments face a dilemma. Neither raise taxes, cut spending, or dilute the currency through further printing. The latter is the most common, and it is precisely this dynamic that undermines faith in paper money. When currency is devalued to meet obligations, the holders of that currency bear the cost. This is a hidden systemic risk, one that is easy to ignore until it becomes impossible to avoid. Monetary policy itself introduces another layer of vulnerability. Central banks attempt to control economic growth, inflation, and employment through interest rates, asset purchases, and other tools. While these measures are designed to stabilize, they can also introduce distortions. Artificially low interest rates may encourage borrowing beyond sustainable levels, creating bubbles in real estate, stocks, or other markets. When these bubbles burst, the resulting losses fall squarely on those who rely solely on currency-based assets. Likewise, sudden shifts in policy can trigger volatility that spreads quickly through the global financial